Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Juliette Sarli. Great to have your company this Thursday afternoon on yet another very busy day on the reporting calendar. Let's have a look at where the market is finishing out the session as we head into that match off. We've seen a little bit of selling coming through in the last couple of hours or so. You can see around 1 p.m. there on the CBO 200 wheel, very firm. Similarly on the ASX 200, which actually hit a fresh record intraday high around 1 p.m. But no surprise, the sellers did start to move in as we count down to the overseas session, and particularly as we've once again seen a lot of these tech players hammered. The info tech sector is actually down by 6.3%, and of course healthcare being weighed too by Medicus's results, and some weakness in that sector which closed towards a 7-year low yesterday, also being dragged down by CSL. But there were some good results out today as well, and in terms of some of our themes, it was really about some of these reporting records, specifically when you look at the banks. You know, we had CBA yesterday, everybody's still picking their jaw up off the floor as to how that one keeps smashing expectations, but ANZ as well with its first quarter, very, very solid, up 17% to $1.94 billion. Nuno Matos, the new CEO, cost-cutting program, I guess if you want to call it, very much in full. ANZ's job restructure program actually saw more than 60% of the planned 3,500 job cuts completed by December. So expenses at the bank down by about 8%, contributing to that lift that you saw coming through in cash profit. So there we go, bank on it, if you will. Those banks really just leading the way. And we also have a very solid Aussie dollar as well. And particularly if you're planning on going to Japan, it's at a 40-year high against the yen, making Japan even cheaper for Aussies. All right, let's get into some of the sectoral moves, specifically with those banks that we've been touching on. CommBank up another 5% today, $177.95. ANZ there up by 8%, above $40, so at a record there too. NAB up by about 2%, Westpac firmer. Macquarie Group just taking a little bit of a dip as we focus in on the big four, but of course Macquarie was very much highlighted in the conference call with CBA yesterday as to how much it's causing a disruption there to the big four. All right, let's have a look as well in terms of what we're seeing with healthcare stocks continuing to weigh. CSL, people are a little bit mixed on this, whether or not the big decline that we saw on the back of its results yesterday means maybe it's a time to buy if you're looking further out. Others, though, continuing to press the sell button. Cochlear also coming under pressure, and of course Medicus very much falling today. We'll get into that in a little bit. And having a look at tech as it continues to fall, particularly on the back of weakness once again coming through on Wall Street in software stocks. Investors very much assessing this stronger than expected jobs report in the US as well, lowering the bet on Fed rate cuts. Let's get into some of the nitty gritty. We touched on ANZ there. We also had reports coming through from AMP. Profit down for the year, shares absolutely whacked, down by 28%. The stock market operator ASX did see a rise in net profit, but higher revenue offset by higher expenses, and shares were under pressure. The gold miners, though, of course, no surprise, had a good half due to record high gold prices. Northern Star up almost 4%. And Temple and Webster, gosh, you do not want to miss in this reporting season, do you? Whacked by almost 32% drop. It had a weaker than expected earnings, although what I thought was interesting was that it now controls almost 3% of Australia's furniture market. Getting into Medicus, it saw its first half profit surge on growth in North America, but there was a miss there in terms of what the market was looking for. So we asked the CEO, Dr. Sam Hupert, how he explains today's share price slide.
That full profit figure takes into account an unrealised profit on an investment, but if you strip that out, our net profit after tax rose circa around 30%. So that's without that particular investment, which clearly did increase the total profit. But without that, as I said, 30% growth in NPAT.
So We also spoke to IAG. They posted a 35% drop in first half profit and announced an on-market share buyback of up to $200 million. And I asked IAG CFO William McDonnell about what he's seeing in the strength of the underlying business.
I set out a target to the market a year ago that we would aim to bring our admin expenses ratio down ex levies down below 11% next year. And I was pleased to show today that we are making really good progress towards that. So from 12.2, now we're at 11.7. We expect to slightly improve that in the second half and then to come down below 11% next year. And that's on the back of a range of things. The benefits from the technology investments we've made, some ongoing AI benefits across the business, and also just some more traditional operational efficiencies.
All right, let's get to our guest now for his thoughts. Jimmy Jang from GBA Capital joining me now. Jimmy, I just want to get your thoughts because it really does seem if you miss, you get whacked in this reporting season.
Eyes needs to be everywhere, Juliet, especially, with these growth-focused stocks that's been, giving a really good returns to the investors is now really coming to that test whether these promises and the thematics that we saw in the market comes true. Medicus, as you kind of briefly highlight, is probably one of the main focus of the day. Look, this is kind of like, in my view, the textbook high multiple growth stock reaction. So look, if you look at the actual result, the revenue growth, around high 20%, so 28% their EBIT, and also their revenue year on year. Margins is north about 70% of the EBIT, and then there's a lot of strong kind of contract wins as well, and most importantly, it's a debt-free balance sheet. So operational, I think it was an exceptional result, but the main thing is the Medicus trades on a very elevated earnings multiple. So if you're priced in for that perfection, even those strong results can obviously trigger a lot of profit taking. So what the market is really saying is, everybody loves the business, we know they can deliver, but we need that even stronger acceleration to, justify the valuation they're at the moment. So I think it's more about the short-term volatility in my view. Structurally, nothing has changed. So their US imaging footprint is also very expanding. The long-term contracts provide a lot of visibility, and their margins are kind of remain world-class at this stage. So I think the risk isn't with the business. I think it's the valuation that the market's been pricing in for a while. So for the long-term investor, I think it's a great pick, at the moment.
Yeah, that's what I was going to ask. I mean, when you see stocks like this absolutely get hit, do you look further out? Because AMP, Temple and Webster also down in the double digits. Let's start with Temple and Webster. As I mentioned, I was really quite surprised to see that it controls about 3% of the furniture market now. It's just growing a lot, isn't it?
And we also need to understand that, also, when we look at the earnings report like this, we got to really read the report. Their revenue was very strong. They're nearly 20% growth. That's quite impressive, especially in this climate of economy where there's a still soft consumer environment that's still going. But the main two things that I think that spooked the market was the net profit. So that fell quite materially, and also the management prioritized the growth over the margin expansion. So, as an investor and a shareholder, we were kind of hoping for a bit more operating leverage, but they got reinvested, right? So in this kind of scenario, we look at like you mentioned, their market share is quite impressive, and especially with this pullback in the market, we look at how the economy might pull up over the next 12 months. Now we have obviously seen that an interest rate hike, so in Australia, and we don't know exactly whether we're going to see another hike or a stabilizing interest rate for the rest of the year, and how that will impact the economy. I think that also kind of got impacted into the pricing of today's share price. So there's a lot of volatility, and I think the market also kind of pricing in that whether the Temple and Webster can actually pull off that margin again in the next 2 quarters, if the economy is going south.
Indeed. All right. What happened with AMP? Was that just sort of a disappointment there that maybe there wasn't a share buyback, or what did you think?
And AMP kind of improved that underlying profit, but the challenge is the good thematic of the blue chips, trust and sustainability. So yes, their underlying profit obviously has improved, and the costs were controlled, and their assets under management also increased as well. But the people are still really still asking, is this that cyclical recovery or that structural growth? Can that inflows be sustained, and how resilient are the margins? So AMP has been a turnaround story for years, and the market needs that consistent delivery across that multiple reporting periods before it kind of re-rates meaningfully. meaningfully. So look, in my view, it's not something I want to touch yet because it is still going through that restructuring. I need some little bit more certainty before I recommend the investment.
Okay, let's get to the big one then. The big kahuna, CBA, out yesterday. I mean, everybody loves to bash on CBA, but they keep batting it out of the park. What did you think?
It's the what we call the premium franchise in the market. You know, that cash profit up mid-single digit is something that I probably haven't seen for a while in a mega cap like CBA. And their dividend increased, the credit quality got stabilized, and the margins is also resilient. So it was a very so-called boring report in the market, especially in this tech looming into the market share, but in a really good way, because obviously market right now is very volatile. And in the macro conditions like what we're seeing at the moment, investors gravitate towards the stability and yield. And at the moment, just from the report, CBA provides both. So as an investor, especially if you got all those good gains from the gold prices and silver prices and critical minerals, if they want to look other way, they probably have no other better stocks than banks right now, especially with the way they show the report, and they're obviously demonstrating very well. So look, I think the valuation isn't that stretched from my view. I think CBA trades at a premium to global peers and domestic banks, but what their market's paying for is that defensive earnings and the return on equity that they're getting on a mega cap like this, which kind of makes it really attractive investment, especially in the volatile time.
Absolutely. All right. Well, thank you, Jimmy, for your thoughts, and of course, maybe looking around for some bargains when they get hit by some of these big slides. Jimmy Jang from GBA Capital. Getting to the call, the stock of the day today, it was an international special, and the stock was TSMC. And we spoke to our experts, Mark Moreland from Value 3, Mark Gardner from MPC Markets.
And I never owned it before was the geopolitical risk argument, which I bought into, saying, well, if China tries to take over or we end up with a war over Taiwan, then Taiwan Semiconductor could be completely screwed. So it's an existential risk. And I've changed my mind on that now, because when I've thought about it and time's gone on, first of all, I don't think China's likely to do that because it'd be an own gold anyway. But even setting aside the likelihood, the reality is if it did happen, we would be screwed anyway, because our whole growth and AI business, everything is based on chips that are coming out of Taiwan. So you can't replace that.
I think if this was a US-based business, I think, and not based in Taiwan, didn't have that geopolitical risk, I think the share price would be 3 times higher already. I think that geopolitical risk is what keeps it cheap, but this is the ultimate steady as she goes. I think there's even more risk in Nvidia, for instance. And not to say that there's risk in Nvidia, but if someone supersedes them, Taiwan Semiconductors are still going to make it. So they're the ultimate sort of bulletproof AI play overall. Absolutely buy. And you add on weakness, it'd probably be the number one stock to add on weakness for us almost. If there's obviously unless there's something to do with Taiwan, but in a broader market pullback, I don't see these guys going backwards very far.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAM. Retirement income done differently.
Let's get into the leaders and laggards in today's session, and of course a lot of volatile moves on the back of reporting season. ANZ looking very solid there, hitting a record high in fact after it impressed investors with its results. CBA continuing to rise on the coattails of its share price, or its result I should say, yesterday. Shares up by almost another 6%. Origin Energy also, it lifted the utilities sector. It upgraded its full year energy markets EBITDA between $1.6 to $1.8 billion. Northern Star also doing well on the back of its quarterly, along with PLS, which was up 3.3%. To the downside though today, well, Temple Webster, we've discussed that one, down by 32%. AMP also getting whacked after its result. Medicus as well, shares having their worst session I think in something like 14 years, and SiteMender and IDP Education also coming under pressure. In the small end of town, Finder had a great session, up by some 21%. but these were the laggards in the small end of town. Coming up on your screen, BetMakers Tech down 15%, Main Pharma down by 9%. Tonight we get UK GDP, US jobless claims, US existing home sales, and earnings continue, including Airbnb, Coinbase, Expedia, and Pinterest. Tomorrow, Friday, we've got earnings coming through from Cochlear. We'll also be speaking to the CEO, Diggory Howard. We've got Westpac's first quarter earnings, GQG Partners, and Nick Scarley also giving updates tomorrow. So the market's closed higher by 0.5%, losing, I guess, about half of its earlier gain where we did see records breached, but still nevertheless a positive finish for the market. And on the ASX 200, we've closed higher by 28 points, a third of 1%, 9,043. If you take away that big decline in tech and of course healthcare dragged down by the likes of CSL and Pro Medicus, it would have been a much better day than that. But despite that 0.5% gain, more sectors actually ended lower than higher, but you had a good gain coming through in utilities, financial, materials and consumer staple stocks today. That does it for today. We'll be back from 9:45 a.m. Eastern tomorrow.